I'm a big fan of ETFs. In fact, the portfolio I'm building here on this channel is invested entirely in one. I've talked before about why I think ETFs are the best way to start investing in stocks, but even with all their benefits, there are two mistakes that people need to avoid when investing in ETFs. And the first one actually ties directly to one of the biggest advantages ETFs are known for. In this video, I'll show you what those mistakes are, and more importantly, how to avoid them. The first, and honestly the most important mistake that can kill returns over time, is trying to trade ETFs, constantly buying and selling them or trying to time the market. One of the biggest advantages of ETFs is the liquidity. You can buy and sell them instantly during market hours just like a stock, and you'll always know exactly what price you can get for your ETF. But that same advantage, that liquidity and being able to buy and sell whenever you want to, can quickly turn and work against you if you start reacting to every little price move. ETFs are meant to make investing simple by providing easy diversification and liquidity. But that same convenience can make it too easy to overtrade, and when you do, you lose the real benefit they're meant for: steady, long-term compounding of a diversified portfolio. As the late Charlie Munger once said, the first rule of compounding is to never interrupt it unnecessarily. The good news is, this is a really easy mistake to avoid. So when you're buying ETFs, be patient, let time do the heavy lifting, and don't try to trade them, because chances are if you do, you're just going to end up killing your returns over time. Now for the second mistake you need to watch out for when investing in ETFs. This mistake is not nearly as bad as trying to trade ETFs, but it's something that I think is still worth mentioning. The thing you need to make sure you understand when investing in ETFs is understanding what's inside your ETF. This mistake usually shows up in a few different ways. The first two are closely related. It's either owning the same ETF under a different ticker or holding ETFs with heavy overlap. To give you an example of holding the same ETF under a different ticker, let's look at VOO, SPY, and IVV. On the surface, they look like three different funds because they have different tickers, but in reality, they all track the exact same index, the S&P 500. The only real difference in any of these ETFs is the company that issues them, and I believe they may have slightly different expense ratios. But other than that, they're the exact same. Now, is it bad to own all three of these ETFs at the same time? Not necessarily, as long as you understand they're all invested in the same thing. The problem comes when you think you're diversified outside of the S&P 500 just because you own three ETFs with a different ticker. You really have to make sure and understand what your ETFs are invested in and what they're tracking. Which brings me to my next point of not understanding what's inside your ETF. This one I think is a mistake most investors make when they start buying ETFs. And that's owning ETFs with heavy overlap. Meaning, while these ETFs are technically different, they hold a lot of the same companies. For example, SCHG and QQQ. Both of those are technically different ETFs, but they're invested in a lot of the same companies. And they actually have approximately 65% overlap by weight. So while the tickers might be different, and the ETFs are technically different ETFs, a lot of the underlying stocks that the ETFs are invested in are very similar. Again, this is not automatically a bad thing as long as you understand it. Just be aware that you may be holding a lot of the same companies in multiple ETFs and could be far more concentrated in one sector than you realize. And the way to avoid this is to simply just look at what the ETFs are holding. The easiest way to do this is to go directly to the ETF's official website and look at the holdings section. From there, you can see every company the fund owns and the weight of each position. It involves a bit of research, but that check can help you understand exactly what you're investing in and whether you might already own a lot of the same companies through other ETFs in your portfolio. So overall, knowing what's inside the ETF, what it holds, what it tracks, and how it operates is key to understanding how it fits into your overall investment strategy. So to recap, mistake number one: trying to trade ETFs and time the market. The ease of liquidity that ETFs offer makes this really tempting, but be aware of it and avoid the urge to constantly trade. Mistake number two: not understanding what's inside the ETF. Take the time to understand what's inside it and how it fits with your other investments. In short, understand what you own and hold your investments for the long term. That's how compounding really starts to work in your favor. If you found this helpful, hit that like button. It really helps the channel grow, and subscribe if you want to follow my journey of building a dividend portfolio from scratch. As always, thanks for watching, and I'll see you next time.